A good day once again. We are back in the classroom, back with the studies of investment analysis and portfolio management. Remember last time when we talked about behavioral finance? We talked about ideas about random walk. We talked about the efficient market hypothesis, that there being a weak form, a strong form, and semi-strong form. But then we talked about another thing, and that was the attitudes of investors. We talked about what they actually did in the stock market. How did they behave? How did they react? And how did they respond to any adverse, sudden change in the market? In this, we studied in behavioral finance topic. We understood that while we were talking about behavioral finance, we had looked at several things that were very conspicuous and obvious with the investors and their psychology and the way they think. So when we talked about behavioral finance, we looked at their attitudes. We looked at the way they were looking at different aspects of investing in capital markets. And we felt that they needed to be studied in a way to understand what herd behavior was. Generally speaking, people who are investing in the stock markets tend to shy away from reality once they feel they have had a setback. They tend to feel that what they did was right, and only time will prove that yes, their decision was right. They have these illusionary thoughts that they were right, the market should have responded in the way that they had behaved, which would mean what? That the market should have actually followed them. They have this hallucination or the illusion that they lead the market, which is wrong. Individual investors never lead markets. Individuals and investors are too small for the market. The market is much bigger than an individual investor. And the market shall never behave the way an investor wants it to behave. The market does not know that you're investing. The share does not know that you own the share. They will behave independently of whatever you might be planning for the stock and for the market. Now, when we talk about behavioral finance, we try to study the patterns that are made up of individual investors over a period of time. And we looked at several different aspects. And while we were looking at the aspects, we looked at how investors thought they were being right. They had thought that there would only be profit and there would be no loss. While they do this, they fail to understand in any business there has to be a loss and there has to be a profit. It's not just that they will be understanding things in a way that you will only consider profit as the ultimate end and there shall be no loss. This was little different from the empirical studies or the research on empirical data or the research that we studied earlier, the different theories. So while we were talking about behavioral finance, we must understand that they had developed concepts and we had to have a casual familiarity with all the concepts. These were established with a variety of behavioral patterns, and these may have affected the security prices or at least influenced the security prices. So this study tends to integrate psychology into the investment process, and thereby we are able to understand how markets behave independently of how investors are behaving otherwise, it would be very difficult to find out what is behind the mindset of investors acting in a certain way. While we were talking about this study, we learned that investors behave in a specifically particular way internationally. This phenomena is not localized. This phenomena is not focused just on this country. This is international, universal, and global. The herd behavior, the behavior of investors is the same everywhere. We tend to forget that maybe we are the only ones behaving this way, but we tend to be wrong because this is how every investor behaves. You'll have investors who are pessimistic by nature, who are optimistic by nature, who have a good vision and insight of the market, and there are others who would maybe just be scratching the surface of the fundamental aspect of the stock market. But we must understand, if we were to look at all the aspects in a collective way, we would understand that the study of human mind and the study specifically of people who invest monies into the capital market is a little bit different than the rest of the people who invest money in businesses. When you're putting in money in businesses, it is a concluded fact that we must understand that there are both aspects of businesses going and doing very well, and businesses perhaps not doing as well as maybe the people or the promoters would have wanted them to be. So when we look at that aspect, we suddenly realize that the investors think that they should only be making profits and they will not be making any loss. And when they do suffer losses, they get upset and confused. And when they get confused, they have these illusionary thoughts of maybe the market is not being fair with them. They fail to understand that they might have misjudged everything and that the result was perhaps because of the mistaken interpretation of all the statistical data that they may have perhaps reviewed. So when we talk about interpretations, we must understand that either you should have superior knowledge about the stock market, or you must have the ability to interpret things. And if you do not have that ability, it's going to be very difficult to satisfy your egos. Since you're not doing your homework right, obviously you'll be taken to task next morning, and the market is not going to spare you. The market never spares anybody once it is in the wrong direction. Once you're investing in the stock market, you either have to have the superior ability or must be trading with the trend. Like I said in one of the earlier lectures, you trade with the trend. You make the trend your friend. You never have a contrarian law. There are contrarian laws, but you behave in contrary ways only if you have got very good knowledge about the capital market. Otherwise, it's best to ride with the tide. It's best to behave, but then that's what herd behavior is. You do what other investors are doing. You look at the crowd around you, you look at the market makers around you and behave in the same pattern. You tend to behave in the same way as the market is behaving. So, we have this loss aversion, we have a fear of regret, and then we have illusionary thoughts that we control the market. एक तो हम डर जाते हैं, लॉस होगा क्या बनेगा. But ये उन लोगों के लिए problem है who have got a specific amount of money that is actually not spare cash. Also, they have this fearful feeling of regretting having invested in the stock market or fear of investing in a particular stock. So this fear factor compounds things. And then the fear of losing. Obviously, it's not going to be fear of making money, it's going to be fear of losing money that compounds your problem. You have hallucinatory effects, and you think everybody is being bad to you, including your friends, including the broker, and including the market. So you think that the market should have reacted the way you should have behaved. But this is not fair. These are things that keep into a person's mind when things are not doing right with the person and his decisions to invest. So then you hold on to the investments, whereas if the investment is giving you a loss, you should get rid of it. And then you should continue with something that's giving you profits. You do it on the other way, and you keep on to the shares that are giving you a loss. And you sell shares that give you profits. In doing so, you're really ruining the capacity to earn. So you think that by holding on to your shares, you'll be able to recover your losses, and this is what we call as a prospect theory. You think things will get better. They may, but it's not going to be because you're holding on to the shares. It's going to be some values associated with the investment that's got nothing to your plannings, that sometimes the prices will get better and you'll be able to recover your losses. It doesn't happen that way. So you must understand while we were training, because whatever studies that we may do, whatever technical or fundamentals that we may do, we must understand is the person who's going to be controlling his thoughts, is the person who's going to be controlling his money matters, is the person who's going to be responsible for any losses and profits. So I think more important to studying fundamentals, even more important than to studying technicals, I think it's more important to study yourself. Know yourself, screen yourself, and find out who you are, what do you want to be, how much money you have, how much money can you afford to lose. Okay, the first thing you must understand is, before you can even think of making a profit, is how much can you lose? How much losses can you withstand? And how much patience do you have? And how much time do you have? This is what you have to understand before you can even think of investing in the stock market. So, in herd behavior, in having a myopic vision of losses, we must understand that we have a certain personality trait that we have to take control of before we get into more losses. The fear of regret, the illusion that you made a right decision, and it's not fair the way the market is behaving with you. So this is important when we talk of herd behavior, or we talk about the general behavioral finance aspect. We must also understand that these include different aspects of a personality that affect your investment decisions. Either you should have superior knowledge about the stock market, or you should have extra abilities to have intuitive forecasting abilities of where the market is going to be in the next few days or the next few months. Other than that, you are bound to face losses. So it is your own capability, and then the ability to screen crowd voices and screen crowd noises to alter your decision. You should have a hindsight into what decisions you've made and where you're going to invest, other than following the crowd, going into tip, getting information, thinking it's insider information. These all will affect your capacity to earn and maybe enhance your losses, minimize your profits. Although it should have been the other way around, that you would have been able to minimize your losses and increase the chances of profits. But these closed thoughts and your ability to follow herds and inability to take control of yourself makes the difference between losses and profits. When we talk about behavioral finance, we must understand that these are things that are going to affect your abilities in the stock market. So herding, anchoring, illusion of control, prospect theory, myopic loss aversion, fear of regret, loss aversion, these are all factors and established behavioral patterns. Besides this, there are other patterns as well. There are other patterns as well that we have to look into. And they include different patterns that are also effective of the aspect that I told you about. It is the dependence on other people, biased expectations about definitely making more money than the rest of the people. Then the availability of information might not be correct and you might be misled. You think you've got the knowledge, you think you're overconfident, and you'll be able to dictate the market. That is where the problems arise from. So you try to put the blame on others. You try to take advantage of the fact that you were right, but the gentleman who gave you the advice was wrong, and that's why you suffered a loss. So these are things that you have to generally avoid. So we misinterpret statistics. We misinterpret information that's coming to us. And that is why we have all these problems. We must be clear when we're looking at technical analysis. We must be able to interpret the graphs. We must be able to look at the figures and find out, yes, this is correct. So certain random numbers seem less important than others, but we must be able to interpret them. Sometimes there are mistaken statistics. We confuse percentages with decimals. We may confuse the apparent order of the figures that have come in, whether they were results of 3 months, 6 months, or 1 year, or maybe even 18 months in special cases, or maybe there was a problem with the sample size of the information that you got from. So maybe we could be looking at risk aversion. We could be looking at people who react differently when they're confronted to losses rather than gains. Gains सबको अच्छे लगते हैं, लेकिन losses जब होते हैं, people get confused and they react violently sometimes, react in a strange way. They tend not to accept loss like a man. So there is a tendency to become less risk averse or even risk seeking when an adverse event occurs. Loss is such an event. Investors may choose to gamble then on an even bigger loss in the hope the big loss or the small loss will disappear. Losses do not evaporate. Losses are there to stay unless you can make amendments. Now, how do you measure all this? How do you measure whether you made good money or bad money, whether the market is doing well or not? You do this by looking at indicators that will tell you where the market is going. So, we look at equity market indicators, sometimes or mostly called index as well. Whenever we're talking locally, we normally ask index ऊपर है या index नीचे है. आज कितने point plus थी market या कितने point minus थी. This is how you evaluate कि हाँ market was bullish or bearish, positive or negative, up or down. This is how you evaluate. So, equity market indicator gives you a composite report of the market on any given day, the behavior of the market on any particular day compared to the previous day or days. Internationally, the most popular one is the Dow Jones Industrial Averages Index, which composes the 30 blue chip companies, and they are all price weighted. Essentially, they add the value, the price of the 30 stocks and divide by 30, which gives you the index. This is the oldest, most well-known measure in the world. We have another one as well, the Standard & Poor's 500 Composite Index. And as the figure is telling you, indicating you, it has 500 large firms in it. Plus, then you express the index number relative to the base of the index value, which is 10. These value-weighted indices, these price and shares are considered, and these are then reflected in the value of the index. The S&P 500 indicates how much the average equity value of the 500 firms in the index has increased relative to the base period or relative to yesterday. NYSE, or the New York Stock Exchange, and NASDAQ index indicator can be looked at other indices in the global horizon. New York Stock Exchange and the National Association of Stock Dealers automated quotation can be considered as benchmarks as well. We can have even the Tokyo Stock Exchange indicator, the Nikkei 225 indicator, which includes actively traded stocks in the index. We also have the French index like the CSE, the London Stock Exchange index called the FTSE, the DAX, the Mexican Sensex, the Kuala Lumpur. There's a number of indicators that you could take note of. So, indices are useful in assessing the performance of an investment, and then the question arises, what index can you choose from? So, it is important to ensure that the chosen index is an accurate proxy for what investor want to measure. What does it mean? It means you cannot compare oranges and apples. It means if you need a stock index for evaluating stocks, you cannot use the bond index, which means a bond portfolio will be measured with a bond index, an equity portfolio has to be measured with an equity index. You cannot mix up the two, it will create confusion. So, indices can be helpful only when you want to use it for what you want to look at, which means if you're looking at a large capitalized index, you cannot use it for your small capitalized valued portfolio. For a small capitalized portfolio, you need a small capitalized based index. That is the bottom line. You cannot mix the two. You have to have separate indices, understand where the market is going. So you have a number of indices, like I mentioned, the DJIA, the S&P 500, the Nikkei 225, and several other regional indicators. It would be a good idea to look at indicators that are near to our own country. So we would be able to find out what's happening in the subcontinent. When I talked about not being able to compare bond indices with equity indices and vice versa, we need to understand how portfolios are constructed and how the indices are constructed to watch the portfolios or to watch the markets. So maybe you can have a price-weighted index in which you'd be able to assign more weightage to higher price stocks and lesser weightage to lesser price stocks. You could have a price-weighted index to measure the performance of stocks. You could also have a volume-based index in which you'd be able to put in companies that are more traded frequently or largely traded, and then you could have an index of maybe 50 or 100 companies that are based on volumes. You could also have a capitalized weightage market index in which you'd look at the market price and the market capitalization of stocks and make them together into a basket. You can have different forms of indices that you take advantage of. So you could have stock index, you could have bond index, you could have fixed income indices, or maybe you could have international indices. So more locally, like I mentioned in the last lecture, what about the Pakistani stock market? We have our own indices. In all the three, we have three stock markets. This you should know by now, with Karachi being the biggest, Islamabad being the newest, and the KSE 100 is the benchmark. We have different indices for Lahore and Islamabad. We generally tend to refer to the Karachi Stock Exchange index called KSE 100. And this is a benchmark of the equity market, but essentially includes 100 stocks listed on the Karachi Stock Exchange. We have 650 plus companies listed on the Karachi Stock Exchange, but we focus on 100 stocks. And this generally represents around 80% of the market. Now, I'd like to mention here, in the Karachi Stock Exchange, we have 34 sectors, and we have the highest market capitalization in each of the 34 sectors getting into the index. So, which means that we would have 34 market representatives from each sector, and then largest market capitalization companies in descending order would make up the rest of the 66 companies to form the KSC 100 index. Now, I mentioned the Lahore Stock Exchange index is called the LSE 25 index, and this was also formed recently in the year 2002, and this includes the top 25 companies being traded at the Lahore Stock Exchange, which means the Karachi Stock Exchange index, the KSE 100 index, is market capitalization based, whereas the LSE 25 index is volume based. So like I said, you can have a number of different indices. We've talked about indices, we've talked about theories, we've talked about behavioral finance, but what are the methods of investing? What are the things that we can invest in? So we can invest in global receipts. So we could be talking about depository receipts in lieu of shares internationally. Since shares are listed in one country, the depository receipts can be traded in another country. So we can talk about global depository receipts or American depository receipts in lieu of the shares being traded in that particular country. Also, we can talk about investing in funds based on countries, which would mean a particular XYZ global fund based on a country, say Pakistan. So international investing would be focused on shares belonging to the Pakistani stock market, which are exclusively put into the fund called the Pakistan Stock Fund, and there is such a fund. So you would have international funds focused on one country, or maybe if it's not Pakistan, it could be a European country, and you would have a specific fund for that country. Or you could invest in individual securities as well, which everybody does, but once again, you need superior quality information to invest in individual security. You could also invest in unit investment trusts, which would mean securing your money much more, or then you would put in money into a local mutual fund, which would be what? A basket of shares, a basket of different products. A mutual fund could have what? Equities, bonds, derivatives, money market, foreign exchange, you name it, that could be included in the fund. But we could also invest not only local fund but international mutual fund. It is a huge market. You could also invest in treasury bonds and bills as well, which would be a fixed income. So you could invest in a number of financial products, and then you could manage those products. There are a number of products available in the market now. So these marketable financial assets are something that one can invest in. We could invest in companies owned by individuals, which always would not be the likable choice, because these are going to be very confusing to study and monitor, because there's going to be very closely held procedures in the accounting and the way they run the market. But yes, you could invest in companies owned by individuals, or these marketable financial assets are generally what one owns. These are products that one has invested in. These marketable assets represent direct exchange of claims between issuer and investor. These marketable financial assets are usually very liquid or are easy to be converted to cash without loss of value. Since the word is marketable, we're not talking about non-marketable events, we're talking about marketable products. So these are very liquid and are easy to convert to cash without loss. There could be saving accounts and bonds, certificates of deposits, money market deposit accounts, a number of accounts that you could turn from cash to another cash, another form to another cash. You could liquidate these assets and you would understand that these are marketable. So these can be held easily as collateral. So these marketable securities can be of great help to somebody who wants to liquidate the asset and get cash in return. Marketable securities are definitely very popular because they're a way of hedging against inflation. They are a way of maximizing your profits because they've been invested into for profit, for capital gain, for dividends, and then whenever you need to liquidate them and have the cash, you can do so. Now, this is a little bit different than investing in real estate or in products that do not have a ready market. Remember, the stock market, the money market is an auction market with a fair pricing function. It is a market with a continuous pricing function. And you are able to get the best possible price for your product, your share in the market at any given day. The chances of you getting ripped off are very rare. So, these marketable securities are a better form of investments than investing into products that might not be saleable or might not be able to be sold at the time that you need the cash. So, these marketable claims are negotiable. They are negotiable or saleable in the market. The beauty about these marketable products is that they're readily transformable from one person to another person. We could be talking about short-term loans. We could be talking about short-term investments. We're talking about liquid, relatively low in risk instruments. We could be talking about instruments that are issued by the governments and private funds. For example, money market mutual funds, treasury bills, commercial papers. These are products that are marketable, are liquid, are short-term, and readily changeable, negotiable, or saleable in the market. People like to invest in such products. Institutions like to park their money in these products because they know they'll be able to cash it very quickly at their convenience. Now, in the capital market securities, we must understand that marketable debt with maturity is also greater than 1 year. So we'll be talking about long-term ownership interests in these activities. Money markets are going to be short-term. Capital market investment is going to be beyond 1 year. Of course, it's going to be more risky than money market securities. Money market securities tend to be less riskier. But remember, they're going to pay you less profit as well. But the stock market activity is more risky, obviously it's going to pay you more as well, but is also for people who are interested in long-term investments. On the other hand, fixed income securities have a specified, determined payment schedule. There's no ambiguity, there's no confusion, and it's very clear what you're going to get from fixed income securities as a return and when. The dates and amount of interest as well as the principal payments are known in advance. There's no element of surprise. Predetermined price, predetermined time, you know what you're getting into, you know when you'll get out and what you will get. No risk, no uncertainty, time and profits and principal amount are almost guaranteed, and you get into this at your convenience for the particular time. Another word that should be exciting to you is securitization. What is securitization? Essentially speaking, it is the transformation of illiquid, non-marketable, risky individual loans into asset-backed securities. If you didn't get the idea what I wanted to tell you, it's transformation of risky assets, illiquid assets into less risky assets and more liquid assets, backed by assets. So these securities then become more acceptable and more marketable and more able to be accepted as more collaterals. Also, we could be talking about GNMAs, which are secured loans, maybe auto loans, credit card loans, debit cards, credit cards. These are cards and loans that are secured by assets, and these are also considered investment products. They're also considered small business loan products. these are also then acceptable as forms of investments. Now, like securitization, these are other products which are high yield, short maturity products. These high yield, short maturity products have got the investment grade ratings. You can invest into a number of products these days and get good returns on your investments, and then you can think about getting risk-free profit, more riskier profits, and then you can think about talking about time frames like investing for the short term and investing for the long term. Now, when we talk about different types of securities, the best type of securities that you could investing into as marketable securities is the equity security, more popularly known as stocks, shares, and people are more aware of the knowledge about stocks. So information on stocks is more freely available than maybe on bonds or commodities or money market. So investment in stocks is one of the more acceptable form of marketable instrument investments. Now, equity securities denotes an ownership interest in a company. You become a stakeholder in a company. We have talked about this several times, but this is a new topic that we are discussing. We're talking about marketable securities. We're talking about alternative securities. Just wanted to make a little bit of mentioning of the equity securities. Now, we can understand that these shares, these equities denote management stakes. They denote the number of people involved in the management process or the number of shares that are being distributed outside the company after having taken in the money. So each share would have each vote, and the number of votes and the number of shares dictate the management conditions whenever there is an election. Also, it denotes limited liability. Your liability in the equity-backed security is up till the amount of what shares you own, which technically means you could lose the amount that you had invested in the shares if things go bad in such a company. But of course, we're talking about profits and losses, we must look at this aspect as well. Obviously, having said that, investors cannot lose more than their investments that have put in. If the corporation fails, if the corporation goes into liquidity, gets bankrupt, their investors are going to be responsible for the number of shares that they've invested. Don't get scared. This is just academic. Not all companies fail, and not all companies are going to go bankrupt. But academically, we must know about these things. What are we going to invest in? While I was talking about equity stocks, also would have wanted to talk about preferred stocks, and that's what I'm doing right now. The word is stocks. We're talking about preferred stocks and equity stocks, but then preferred stocks are not stocks. Yes, they are, and they are not. Don't get confused. Preferred stocks are stocks, but behave like bonds. These are hybrid securities because features of both debt and equity. They're shares and they're bonds. So that means they're hybrid because they're bonds also and shares also. So preferred stockholders are paid after debt, but before common stockholders. We're talking about the bad times. When talking about preferred stocks, we're talking about preferential treatment to people who own these stocks. We're talking about priority over common stock. Obviously, the name implies common is common, preferred would come first. We know in preferred stock what the dividend is, and that is fixed in advance before somebody acquires preferred stock. So then, obviously, that means it's just like a bond. May be accumulated if dividend is omitted. You have announced a certain dividend that you're going to pay the preferred stockholder, but you may omit it once. You've got to pay it the next time. You may omit it twice. You've got to pay the cumulative effect the third time. They're not going to get away with not paying you dividends. So in preferred stock, you've got to be given a certain percentage of dividends predetermined before somebody buys it. Plus, it is often convertible into common stock as well. When the time reached, when things are right, you may be given the opportunity of converting preferred stock into common stock. It may very rarely carry variable dividend rates depending on the number of years you're going to continue with the preferred stock, but it may. Generally, they don't. In common stocks, shareholders are residual claimants on incomes and assets. Talking about bad times again, you get to get the leftovers. After the government has had its share, the preferred shareholders have gotten theirs, you are the last to get whatever is left. You get the doggy bag. That's the common shareholder. But we don't talk about this normally. This is academic, and that's why I'm telling you. So par value is the face value of a share, and this is usually economically insignificant. We're not talking about par values and face values. We're talking about stock market. We're talking about market prices. We're talking about market forces making the difference between what people are interested in. Stock prices at the face value, stock prices, the par value are things of the times gone past, with those were the times when somebody issued the shares for once. So market value is more significant. Book value is significant in accounting and calculating the value of a share in case a company goes bankrupt. Otherwise, we're really not worried about such an issue. In stocks, dividends are cash payments to the shareholders. Dividend yield is income component of return. Payout ratio is ratio of dividends to earnings. These are the things. And then we talked about declaration date, ex-dividend date, the record of who's holding on to the shares, and when the payment is going. So we talked about payout ratios, dividends, earning per shares, price earning ratios while we were talking about common stock. We also talked about stock dividend. The stock dividend is payment to owners in stock. Stock split is the issuance of additional shares in proportion to the shares outstanding. Par value and book value may be changed. The value in money terms doesn't change. And price earning ratio is the ratio of current market price of equity to the firm's earnings. This must have given you a good idea of what we've been talking about in the previous lectures. Just a revision, quick revision. Now, a little while ago, I talked about investing internationally. Investing in mutual funds of international status, investing in country funds in another country, and investing internationally. While we were talking about investing internationally, did I tell you we're talking about direct investing or indirect investing? Well, you could do that, but directly opening up an account outside and using the internet, or talking about using foreign currency as means of doing business. You could dabble in money markets, you could dabble in commodities, or you could dabble in international stocks, provided you have the hindsight and the knowledge about these, but you can invest internationally. But why talk about international investment when you can do it right here in our own country? You could have any account in any country, provided you have got the cash and provided the law there permits you as a foreigner to invest, and then you could deal through a broker in that country. Let's say if you're talking about investing internationally in the US market, US stock brokers would then handle your accounts. Remember, when we talk about investing directly, we still have to go through a broker. We still have to go through a member of the stock exchange. When we're talking about direct investing, it doesn't mean that we're going to be buyers and sellers directly. We're talking about investing again through a broker, but it's a little bit different than investing through a mutual fund. Because when we invest in a mutual fund, we're talking about indirect investments. We're talking about direct investment. It'll still be through a broker, or maybe there'll be foreign firms who list the securities on the US markets. So there'll be companies, they're listed in one country, but big enough to get themselves listed on an international market as well, like the US market. We here in our country also have companies which are also listed on the US market. The wonderful companies that are functioning here locally but are listed in NASDAQ and being traded there as well. This is something to be proud of. You can trade directly in international markets. Firms are also listed to be traded on the stock market. And then I mentioned you could purchase American depository receipts. You could purchase global depository receipts, more commonly known as ADRs and GDRs. Now, what are these? ADRs, or American depository receipts, are issued by depositories having physical possession of foreign securities. And investors are isolated from currency fluctuations. So what does it mean? It means if there is a stock of an emerging market, people or investors in developed markets might not be interested in investing in shares of an emerging market because of fear of currency fluctuations. When we talk about risk, and we'll do it later in subsequent lectures, one of the risks that people are worried about is currency fluctuation risk. And in currency fluctuation risk, they're scared of currencies that are not very strong. So they rather not invest in weaker economies. To help that problem, a condition has been developed in which you can have possession of the shares, and against them you can trade the shares in your local currency, preferably an international currency, preferably dollars, pounds, or euros, and then they will be called American depository receipts or global depository receipts, as and when you need to use that term. But you will have an asset-backed security or an asset-backed product based on a foreign currency's shares, but traded in your own currency, an international currency. And that would become a very good form of investing internationally. Now, when we're talking about international investments, we must understand that there are times that you would be talking about risks. There are several forms of risk that we could get messed up with. There could be country risk or sovereign risk. There could be political risk. There could be interest rate risk. There could be economic risk. There could be a regional risk, or there could be a risk in that specific company as well. Inflation risk is also important that we must understand. And when we talk about risk, we must understand that these risks are risks that we have to talk about as in terms of being able to invest internationally or locally. Now, risk can be what? External and internal. So what do? Maybe have a SWOT analysis. SWOT analysis would be strengths, weaknesses, opportunities, and threats. You could apply that to the country. You could apply that to the region. You could apply that to the economy. You could apply that to the company. You could make it a proper pyramid. You could make it an inverted pyramid from macro to micro. You fine-tune and find out what the risk and rewards are. While I'm talking about risk and rewards, we'll talk about that in much detail in other lectures that are going to follow. But before that, before I conclude this lecture, let you know what's going to come ahead. We'll be talking about bonds, a little bit about maybe mutual funds again, but it's going to be mostly bonds and the risk involved in trading. And then we'll later on talk about portfolios and how you're going to manage them. Thank you very much.